Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, we have the fund manager, Kelli Meagher of Sage Capital. And Kelli argues the case that there are some travel stocks that are really worth investing in. Which ones are they? Well, we wait and see. We'll be talking about those in just a moment. And then I examine whether payment companies are dead in the water as investments or are they in the buy zone. I look at what the analysts are saying rather than what I'm saying, but what the analysts who are paid to analyse companies and work out their future, what they're saying about some of these payment companies like Tyro and Zip and all those others, Afterpay, that have been really clobbered recently. And then we have a mortgage broker who shows you how you can get the best interest rate, considering the fact that home loan interest rates will be on the way up, with the cash rate bound to go higher. If it's not next Tuesday, it'll be the first Tuesday in May. And that's the show. Let's kick off with Kelli Meagher of Sage Capital. All right, joining me now is Kelli Meagher, Portfolio Manager at Sage Capital. And she wants to talk about travel stocks in particular, but let's just get an overall feeling about what she's seeing in the market. Kelli, thanks for joining us.
Thanks, Peter. Thanks for having me.
Okay, what are you seeing with the market right now? There's a lot of nervousness. I think the Australian market nearly hit an all-time high last week. And well, I noted also, interestingly, that S&P 500 is down about 8% and we're only down about 2%. But what are you seeing as the main drivers of this negativity right now?
Well, I think, Peter, interest rates going up is the clear issue that is making the market nervous. However, historically, we see bond yields going up and the equities market sell off. And in the last few months, we've sort of had to throw away the textbooks somewhat, and because there's been days where bond yields have rallied and the equities market has rallied as well, which doesn't actually mathematically make a lot of sense. But it has to be said that if interest rates are going to continue to go up, then that's going to put pressure on asset prices and PE ratios, which is going to ultimately have a negative effect on the equities market. But I guess a difference to note between the US market and the Aussie market is that we've got a lot more resources, and resources have obviously been very strong. With the Ukraine-Russian crisis and supply shocks there. A lot of the commodity prices have gone for a huge run, and our companies here in that space have benefited from that. So we're not seeing headline, our market is looking stronger than the US, but a lot of that's been driven by the resource side of the market.
Kelli, at the moment, of course, resources are being helped, even though it's having a bad run for the last couple of days. They've been helped by the Ukraine war, which has pushed up energy prices, and even demand for iron ore out of China has been pretty strong. But if, for example, the Ukraine war is solved over the next 2 or 3 months, and China gets out of its pandemic lockdown problems, would you expect the view to be that the global economic rebound would become an important focus, and that still should be good for resource stocks?
I think that those things you just mentioned are just so unlikely that I'm not sure that it's. I think that even if the conflict in the Ukraine and Russia ended tomorrow, the sanctions that have been applied are not going to end tomorrow. The history shows that sanctions tend to last for a very, very, very long time. And so that will continue to put tightness in supply chains, supply of resources, and drive the commodity prices higher. So I just think that situation is just so far beyond, as much as we'd love the conflict over there to end, I just don't think it's going to happen anytime soon.
And your view on China is the same? You think that the pandemic problems are going to be there for a long time?
Well, that's a little bit possibly more likely for China maybe to get on top of the pandemic and for that country to open up. And if that happened, then obviously with Shanghai lockdown at the moment, for example, that's causing extra issues with supply chain delays and increased freight costs. And so those sort of issues would be less of a problem if everything opened up again, and obviously be very good for a lot of different industries like travel and tourism and the like. But yeah, again, it's one of those things which I guess we're not sort of spending too much time pondering those things because we feel that it's probably not likely in the medium term, that's for sure.
Okay, so let's go to the area that you want to talk about, namely travel stocks. Does the travel stock sector need the global economy heading back to normalcy to get the next leg up, or do you think there can be more legs up even with what's going on in the Ukraine and also China?
So the reason we like the travel sector is just that it is, I think it can march to the beat of its own drum, no matter what's happening from a broad macro perspective, because it has been depressed for so long. There's so much pent up demand for travel. Here in Australia, there's a whole lot of excess savings that people have in their bank accounts that they've saved through the pandemic. I'm sure they've been spending a lot more on goods than services in the last couple of years, but that's been so stimulation from the government that people have excess savings that they're really keen to spend. And I think we're just going to see a shift from spending on stuff that we saw in the pandemic. A lot of people spent a lot on stuff and not a lot on services, and that's going to shift now from people spending less money on stuff and more money on services, and travel is going to be one of the beneficiaries. And we're starting to see that. You're seeing huge spikes in demand for travel whenever there's a relaxation of impediments. So the fewer impediments there are to travel, the stronger the demand's going to be. And we're obviously seeing a trend there to not having to have be tested upon return to Australia. And as we see more and more restrictions being lifted, demand will continue to grow. And a lot of these companies have cut their costs back during the last couple of years, and their cost bases are way lower than they were before the pandemic. And many of them, or one in particular, is a much stronger and bigger company coming out of this than they were going in, and that's corporate travel. So out of all the travel companies, they all raised money through the pandemic, but corporate travel was pretty much the only one that didn't raise money to survive. They raised money to make some pretty clever acquisitions. One in the US, which has been a transformative acquisition for them, that makes them a real meaningful player over there in corporate travel, and more recently a smaller corporate travel business in Australia. So we like corporate travel over the longer term, just because it is now in a much stronger position to gain market share. So we don't have to see a full rebound of corporate travel back to the levels it was prior to the pandemic for corporate travel to grow its earnings, because it's a market share game and a margin game, and as they now they're bigger and stronger, we expect those benefits to really start flowing through.
Yeah. Are there any other local travel stocks that you like as a consequence of your analysis?
Yeah, so the other one we do like Qantas. They've cut costs. They have hedged they've got their fuel hedging pretty well sorted for at least till the end of the year. And they've got a lot of pricing power, especially here in Australia with their dominant market position. And so any extra fuel costs should be able to be passed through to the consumer who's who's still pretty keen to travel, they can raise their ticket prices by, say, 10%. That should cover the cost of fuel with the oil price at, say, $130. I think that anyone who is keen to travel to go on a holiday and was going to pay $200 for their tickets, probably okay to pay $220 for their tickets, so that they can recoup the fuel costs there. And the other one that I think is probably going to continue to go up, even though maybe fundamentals should say otherwise, is Flight Centre, simply because it's a well-known name and it's a go-to stock for many investors who want exposure to travel. But they are fighting a lot more headwinds than someone like a corporate travel, because they're fighting things like the airlines cutting commissions. So, a lot of airlines around the world are struggling and trying to recoup some of their losses through COVID, and they're cutting the amount of money that they're willing to pay travel agents to on-sell their tickets. And Flight Centre is going to bear the brunt of that, and so they're going to have to make up their money somewhere else, maybe by charging when you walk into a Flight Centre, charging to sit down and talk to someone about your itinerary. So, and finding staff is very difficult. So they cut a huge amount of staff, and as we know, good staff are hard to find, or any staff, frankly, right now is hard to find for most industries, and so that's going to be another headwind for them.
Okay, so Kelli, when you guys acquire a stock, what kind of time frame are you looking at to start making money on that stock?
We have varying timeframes, I suppose. We are quite active traders, so we'll buy a stock with a view maybe of holding it just for maybe 3 months, or we might buy a company that we really believe in over the long term and hold that position for many years. But I think it's fair to say that we do adjust our positions fairly regularly with any incremental new information. It doesn't necessarily mean buying a stock and then selling out of it the next day. It might just mean that we've trimmed our position or bought a bit more because there's new information that's come to light, and that we like to get that reflected in the portfolio pretty much immediately.
Okay. Well, a lot of people are asking me, with tech stocks so heavily sold off, and particularly payment stocks sold off, have you been looking at some tech stocks from the point of view of they look like very good value if you're prepared to hold them for some time?
At this stage, we're still pretty. We're just taking a back seat with most of the tech stocks right now. Most of them have a little bit we feel that they can fall a little bit further. But there's certainly ones that we would love to be buying when the time is right. Companies such as Pro Medicus, which is just an amazing, fantastic, med tech company with an enormous addressable market, and ed tech companies like IDP Education, which historically trades on very high multiples. It's being sold off, but once we're closely watching for any of these high quality, high return on capital companies when their PE ratios come back a little bit further, we'll be looking to buy. But for now, we're still cautious on anything that has a high PE or anything that has the requirement to raise capital, because it's a pretty tricky environment to raise capital at the moment. So we're steering clear of anything that's going to need to raise money.
Yeah, really good point. Kelli, thanks for joining us.
Thanks, Peter.
That's Kelli Meagher of Sage Capital. In recent times, payments companies like Afterpay and Zip, Tyro, EML Payments and others have been really smashed by the markets, and some part of the reason for it is the fact that they are tech companies, and tech companies also have been smashed as well. But there seems to be a real set against payments companies that once were unbelievably popular. And so people ask me, are they really in the buy zone? Are they a buying opportunity for someone who's prepared to wait? And I know some people don't like waiting very long. Let's just have a look at what the experts are saying about these companies, which have, as I've said, been really, really smashed in recent times. Have a look at this table here on the screen. It shows you a company like Square 2, which is where Afterpay is nowadays, really in a company called Block, but their ticker code is SQ2. The consensus rise by the experts who look at these companies, on average says the share price should rise 47.9%, at least over the next year. Macquarie is even more positive with a 40.58% price rise on the company. Tyro, on the other hand, 151%. Morgan Stanley is unbelievably positive on the company, 298%. EML Payments, which has had a real torrid time recently, on one hand exciting the market and then disappointing the market. Ord Minnett thinks it's 153% upside is potentially there for the company. The average is 105%. So what is clear is that the analysts still like these companies despite the fact that the overall stock market, driven by fund managers and the really big players, aren't keen to buy these stocks right now. And many of these stocks are being shorted at this point in time. I think it's a really important point to say, well, it's not just these individual companies, it's pretty well all payments companies are copying it. And one of the most famous ones in the world, and probably one of the most highly respected payments companies in the world, would have to be PayPal. And I'll just put up on screen the chart of what's happened in this company over the last few years. This is the chart, the 5-year chart of PayPal. And what you can see there is this was about $120 stock before the coronavirus crash. It fell into a big hole, as most stocks did, but it's had a huge recovery. Peaked out around $308 in July 2021. But now it's an $83 stock. It's a 73% smashing. At the same time, a company like Zip has come down from $8.30 in July last year to $1.03, which is a 90% collapse. Now, I'm not comparing Zip to PayPal. I think PayPal has a much broader and much bigger audience at this point in time, but certainly you can see payments companies, whether they be really well-known, well-grounded, successful companies like PayPal or up-and-comers like Zipper, they've all been really, really smashed. And so I think the important point is this is not just something of some local payments companies being knocked around by the market. It's all payments companies. And as I said earlier, it's partly linked to the fact that they're tech companies, but they're also payments companies. They do borrow a lot of money and interest rates are on the rise, but these companies were borrowing money beforehand and they're used to higher interest rates. There should be more behind this than just simply these companies are out of favour and will remain out of favour for a long time. As I pointed out previously, the experts who look at these companies and are paid to do so, they're pretty positive on what these companies can do in the future. The question is, how long will it take? I thought it might be interesting, rather than just focusing on what local analysts are saying about payments companies, is to look at what US analysts are saying about the big name companies in the payment space. And what you can see on screen now is the view from CNN and its money section. They survey, in this case, 43 analysts, and they are 12-month price forecasts. And this is PayPal we're looking at on screen right now. And what you can see there is that the low forecast is $105, but the company is $83 today. The median, the average or the median price is $174, and the most optimistic has $245 there. So as you can see, there's a fair degree of confidence that a company like PayPal can turn around the negativity that's dominating its share price right now. For locals who have been Afterpay shareholders, They're of course now holding block shares, and SQ is the ticker code in the US. And once again, the analysts in the US are positive about the company over the next year. The low is $110, and that would be a 12.5% fall from when I took that particular chart shot. But the bottom line is the average is around 175 and the high is around 240. As you can see, there's a lot of people still believing that the payments companies have futures not only here in Australia with our analysts, but also in the US as well. So as I've said, the experts are pretty positive about PayPal and other payments companies as well. But let's go back to that PayPal chart to test out whether the current sell-off looks a bit overdone. Now what you can see here is that the current share price is around $82. The pre-pandemic high was $120. And then the share price rocketed over the period where people were locked down. And I think that $308 price came out of that, the fact that the company benefited from the fact that people were buying stuff online using PayPal. But I still think that the sell-off does look overdone. And so do the analysts, which I showed you in the previous chart. So I think the bottom line is that buy now, pay later companies, I think this is an important point. If you think the people who like buy now, pay later companies, which primarily are younger people, but older people have got into it since the coronavirus lockdowns, if you think these younger people are going to give up on buy now, pay later companies in the future, well then maybe the market's getting it right. But if you think that the trend will be that more and more people will use buy now, pay later rather than credit cards, which a lot of experts think is going to be the case, these companies certainly have a future. And it's probably likely that the current prices we're seeing are far too low. I'm not suggesting they'll go back to where they were. They might, but I'm not suggesting that. But I think if you're patient, probably these companies are a reasonable buying opportunity right now. But as I say, you'll have to be patient. It's not advice. It's just my best educational guess, looking at the figures and also respecting the work done by analysts who are paid to be experts in these sorts of things. I hope I'm right. Whenever I'm asked about whether interest rates are going to rise and how will people cope with the rising interest rates, I always say to them, well, make sure you actually go into this interest rate rising cycle with the best possible interest rate you can get. And I say you should at least go to a couple of mortgage brokers to see if they can do you a better deal before interest rates start to rise. I'm going to talk now to Rebecca Jarrett-Dalton, who started the business called Two Red Shoes, and she is a mortgage broker. Rebecca, thanks for joining us.
Thanks for having me.
Two Red Shoes. A lot of people will be asking, why did you call your business Two Red Shoes?
We're drawing upon the famous analogy from The Wizard of Oz, of course. There's no place like your home.
Yeah, exactly right. And that's what mortgage brokers are involved in invariably. If they're not doing investment properties, they're looking after people trying to get into a home. And I'm sure you have had people contacting you about whether they could do better in terms of interest rates right now ahead of rising interest rates.
Absolutely. It's really busy at the moment and everybody is taking advantage of the competitive nature that the banks have all taken aboard at the moment.
Yeah. You know, I've been surprised. One of our financial planning clients, he actually asked, could he refinance? And I said, well, what interest rate are you on now? And of course, like most people, he wasn't sure. When he looked it up, he was on 3.5%, which maybe 3 or 4 years ago sounded like a good rate. But nowadays, what kind of rate are you telling people is possible if they are good risks for a lender?
Right, and you've hit the key there. So good risks, good profile, etc. There's rates that are in the low 2s, some still around in the high 1s. So that's variable rate. So it is worth having that conversation.
Yeah. Okay. So if someone wants to qualify for these really low rates, what typical profile would they have to have for the lender to give them a tick?
All right, the biggest factor is equity. You want to be borrowing under 80% of the value of the property at least, if not 60 or 70%. That's going to put you better. And obviously you want to have clean credit. You want to have a fairly stable residential and job history. So be in your job for a little while, have stayed in your home for a little while, not too many other loans or liabilities. Basically it's equity that's the biggest factor.
Okay, when people ask me about fixing, I say, well, if you're going to fix, don't fix for 1 or 2, at least go 3, maybe even 4 years, because this interest rate cycle is probably going to go up at least for 2 years. Let's hope it goes for 2. If it doesn't go for 2, we're going to be in a lot of recession trouble, I think. What are you saying around fixed rates, and what can people get for 3 or 4 year fixed rates?
Look, that's a really challenging question at the moment. Again, it depends on your profile. And essentially, if you're taking a fixed rate right now, you're giving yourself an automatic rate rise because the fixed rates are between 1% and 2% higher than the current variable rates on offer. So you have to really weigh up your circumstances. Obviously, there's a lot going on. How long will you be in the property? How rapidly can you repay it? So there are those basic factors, but again, just be mindful that you could be automatically giving yourself even up to a 2% rate rise at the moment.
Yeah, because there is a diversity of views from economists about how many interest rate rises this year, and probably the lowest is 3, and probably the worst I've heard is 5. You might have heard higher. What are you
I think
hearing?
5 is about the most that I've heard at this stage.
Yeah.
But Peter, what I would say to you is that you were actually the most accurate predictor of the economy and the way it was performed over the last 2 years. So maybe we should look in your crystal ball.
Yeah, thanks. So obviously you went to one of my conferences, did you? Okay,
Yeah.
Right. Okay, great. It's good that my guests are promoting me. I love that. All right. So given what I'm seeing out there, if someone is currently on a 3% home loan, and they are a good risk, they've got a good steady job, you're saying basically a mortgage broker probably could get you something around 2%.
We'd hope to, absolutely. And doing that will help you if you need to do anything else down the track. We must remember lenders are always assessing our applications at 3% over the current interest rates, allowing for that prudent buffer. So if you're already at 3.5%, for example, then they're going to be assessing you at 6.5%, and that becomes quite challenging.
Yeah. So to explain to people how the lender factors the buffer in.
Quite simple. What's the interest rate that you're going to be paying? Add their buffer, which is minimum 2.5% to 3% on top, and then work out if you've still got affordability to make those repayments.
Okay. Are you seeing people coming to you saying, "Look, I think I have over borrowed, and I don't think I could cope with a 2% rise in interest rates"? Are you seeing people like that yet?
To an extent. So they tend to have consumer debt. They might have car loans or personal loans, credit cards. They're the people who are perhaps feeling it a little bit harder, and maybe they're looking at consolidating those loans. Generally, my mortgage clients aren't terribly stressed. They know they've been assessed over, and we've been encouraging them to pay over through the whole of COVID. Yeah.
In terms of someone trying to incorporate all their debt into a refinancing package, once again, provided they are a good risk, are lenders comfortable in doing that?
Yeah, that's right. I mean, we don't like to see 9 or 10 debts coming in, but if you've got 1 or 2, a smaller number, yeah, they're comfortable.
What's the kind of reception investors are getting from lenders right now? Are they playing hardball, or are they being quite accepting?
So shall we talk about my opinion or the facts? So it's a little bit more challenging for investors at the moment because the rent that they receive is discounted really heavily. And then from that discounted point, they deduct the investment expenses, so the actual running costs of the property. And that makes it quite challenging for them to qualify. But is appetite there for investment lending? Yes, there it is.
I guess I'm keen to know how you would compare the health of the lending market now compared to, say, a year ago. Is it becoming tougher for people to get an approval for a loan?
It's tougher because the mandatory buffer rate went up by 0.5%, but in terms of appetite or in terms of ease of approval, the scrutiny on living expenses, that has probably eased a little of late.
So if someone comes to you and they have a great appetite for Wagyu beef and Shiraz produced by Penfolds Grange, they're still getting home loans, are they?
So the conversation comes back to what your regular expenses are, what your discretionary expenses, and what's absolutely necessary in your life.
Yeah, okay. Is there any other issue you think people out there should be aware of when they are trying to prepare for this period where interest rates are going to rise?
Yeah, well, like I say, reduce that buffer, reduce that lower rate that you're coming into, get rid of any unnecessary debt, just pay it off, get rid of it. Then, the payment isn't going to be painful, and as well, it won't impact your approval criteria. Minimize your expenses. The buy now, pay laters, they're not helping. Banks don't really understand them, so they just treat them as a constant loan. It's just the standard stuff. It's nothing extraordinary.
Yeah. So where are you based, Rebecca?
I'm out in Sydney. I'm actually towards the Blue Mountains.
Okay. And are you finding that you're getting more work online, or is it still like good old face-to-face seeing people?
More people are comfortable with online, and that's I think maybe it's a time-saving factor for them. They don't have to think about cleaning their house before I arrive. Very comfortable and confident, and there's lots of systems that have come on board helping us do that. Online ID systems, digital signing on our mortgages. Everything's gotten a lot easier from the technology perspective.
Okay, great. Thanks for joining us, and let's hope your observations are helpful to people out there who need to get ready for an interest rate rising cycle.
Yep, thank you so much.
Pleasure. That's Rebecca Jarrett-Dalton from a company called Two Red Shoes. And that's the show, and don't forget we're back on Monday. And I'm interviewing the Managing Director of Xero. This is a company that I like and a lot of my experts on this program like. It hasn't been doing as well as many would have expected. Let's just see what lies out there with a man who would know where this company is going. So that's Monday's show, MD of Xero. That's the show, as I say. If you want any more information about us, go to switzer.com.au or sign up for the Switzer Report, switzerreport.com.au. Thanks again for joining us. I'm Peter Switzer.